So you just said a few moments ago, you were saying we're on a 13-year bull run, right? Meaning we've really had, financially, in the markets, we've been doing really well for a real long time.
Yep.
And the longer we're in it, the longer it's been since we remember what it was like to not be.
Right.
And human nature dictates that the longer we go on from something, the more we tend to forget, the less we remember how to even deal with things that it may have been a minute since we dealt with them.
Right.
As a financial dude, talking with your clients or even just for yourself, what would you say is the proper, I know there's probably not one, I'm assuming this is a question, if I ask 10 financial people, I get 12 answers, I think. But speaking with you specifically, 13-year bull run, market's really good. Let's say there's a kid who's 20, 13 years ago there were 7. So they don't even know a world in which the markets were not good. How do you tell someone to prepare for a potential world in which things might not be what they are right now?
Well, a 13-year-old kid, I mean, it's not going to affect them, too much.
Okay. And why not?
Because they don't have any money. They're not making any money. It's their mom and dad's money that they're potentially going to inherit and all that type of stuff.
Will the fact that they're young mean that their recovery time is great, meaning they have more time to recover than an older person?
Well, not at 13. I mean, they don't even have anything exposed. But yes, if the younger you are, if eventually we have a downturn, and it's not really an if, it's a when.
Got it.
And yes, this bull run has made everybody look at a genius. I mean, you could throw a dart at the board the last 10 years and you would have made money. That's how simple it's been.
Crazy, yeah.
And so this I wanted to talk about anyways, where it becomes a bigger deal for people is what we call the retirement red zone.
Ooh,
and when you think about in football, it's that last 20 yards, right? Well, for us, it's really 10 years. It's 5 years before and 5 years after retirement, because those are the most crucial times. You're approaching retirement, getting ready for retirement, thinking about retirement, want to make sure all your finances are buttoned up. Your risk changes dramatically in that time period. So if we have a downturn during that first 5, period, or we lose 20% in the market or whatever it may be, that might extend your retirement. Who wants that, right? So that's why that first 5 years is crucial. 5 years is a hard, not enough time usually to make something up if we have a huge downturn.
Right.
Now, the pandemic downturn that we had, I feel was a precursor, but that came back much faster than anybody could have predicted. You're going to have people out there that are talking, oh, no, we saw this coming, blah, 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 the bullshit. So that before retirement is important. Then you have 5 years after, because you retire, you don't want the next day lose half of your portfolio, lose 20%, 10%, whatever it may be, because you're counting on living for that.
Right.
And people are always like, well, how much money do I need in retirement? Well, there's so many variables with that. Like, you can't answer that with just a 5-minute conversation. Like, there's so many variables with how much money do I need in retirement. So that 5-year period after is crucial, and your risk changes. Once you get a little further in retirement and you kind of see how things are going, how you're spending, all that type of stuff, then you can make, your changes. But so that 10-year window is really...
And because of that, you're really thinking only somewhere around 5 years into retirement, because by the time 5 years rolls around that you've already been retired, you get a pretty accurate idea of what your...
Well, that, and you have Social Security, your pension is potentially full coming out. You're now on, Medicare, or however your insurance is going to happen, for that 5 years after. So a lot more things kind of trigger in that time period, depending on when you retire. So that it's a crucial time for your retirement, for planning purpose, all that type of stuff, for when to happen. So that's what we really focus on, and we kind of target those individuals because nobody's really paying attention to those individuals, and a lot of people get complacent. The 10-year, 13-year bull run, people are getting complacent. They're forgetting about their portfolios and the fact that we can lose money. People last week have been waking up because we've had a lot more volatility, and it's volatility to the downside. So, I mean, there's still your talking heads that are saying, oh, no, we're going to all-time highs, we're going to do this, and nobody knows yet. We're still in the precursor of a potential bear market. We haven't fully blown into it yet, but we're not.
And for people listening, bearish is basically
down,
not good.
Right.
And then bullish, a bull run, like we were saying, is good.
Right.
It's a good run.
Yep.
from your perspective, how much do you devote, you specifically or just people in your shoes, how much do you devote when you deal with clients to reminding them, or maybe to just making it present in the conversation, the fact that we could not be in a bull run forever? How much does that play into
once they're a client, it doesn't
really play.
happen. Yeah, because they're keen to now the reality of what they have available to them, the tools at their disposal, and all that type of stuff. It's beforehand. It's and it's why I don't talk. When my initial approach is taxes. I'm not a tax attorney. I don't do taxes, anything like that. But I have some knowledge that can guide people to then I connect them with the right type of tax people that I know are doing the strategies that we talked about and how it can be implemented. So that kind of opens their eyes to things. And then we start talking about, okay, hey, look at this chart. I had a client, she was young, gave me her portfolio that a typical advisor puts them in. They were mutual funds. Mm-hmm. They were commission-based mutual funds. So the advisor was making a pretty good, money off of these mutual funds.
And this
is
like
ridiculous.
A big Morgan Stanley type thing.
It wasn't Morgan Stanley. It was, I don't remember
it was a big firm.
It was a bigger firm.
Got
Yes, it was a smaller firm, but she worked for the bigger firm. And I showed her. She had probably 10 different mutual funds, and I took all those mutual funds and I put a graph for each of them, because they don't show you the performance of each one, and you could overlay all the graphs and they all look the same. They had the same, anytime the market downturned, they all went down, so there was no diversification in there. Not only that, but they all had, and the reason for that is because they all had the same stocks inside that mutual fund, and most of the stocks are the FANG, which is Facebook, Amazon, Netflix, Google.
What is it? FANG?
FANG, yeah. Facebook, Amazon, Netflix, Google. I'm missing one.
I love it. You guys have acronyms.
But they control, 35% of the market. So most of these mutual funds that they have are going to have those stocks because they've had the growth, they've had the technology.
But there's no diversification.
Right. So they give you 10 different mutual funds saying I'm diversifying you, but it's not doing you any favors.
Because it's all similar to each other.
Right. So that's waking people up that way, being like, hey, look at my portfolio and what do you have me in? Is this really doing me any good? And most of the time it's not. And that's kind of my starting point of, hey, look at this. This is stupid. It's not, you're spreading your money out. You're paying them for a fee to do this when it means nothing, type of thing.